Morning, Friday the 10th of February. So let's just take a quick run through of how we've opened up this morning and relative risk on in terms of overnight developments. There's been some Chinese data which we'll talk about shortly, but overall continued move higher that we saw yesterday, initiated by those comments specifically on tax issues by Trump, catapulted US indices back to their highest levels again. Just looking at the Dow and the S&P, obviously that 2300, again the initiation really of that move coming, what was really a very, very quiet day yesterday, all the way up till the point when really Trump made those tweets. It's one of those days where there wasn't really a lot on the calendar. There's also adverse weather conditions on the northeast coast, which again, I know some of the newer guys, you probably might not think like that, but obviously when there is a high degree of snowfall, that affects transportation, and actual trading volumes does drop usually significantly in that situation. So that probably also contributed to some of the lack of liquidity. But then when the comments hit, obviously, if you do have a fairly illiquid market, then all the more kind of powerful the move is then when some orders flow through the market. And certainly as soon as we broke up through that 2300, we kind of continued higher all the way into the close on Wall Street, really, and we're trading up just shy of those highs at the moment. The Dow, of course, almost feels like 20,000 is just long gone now from where we were only like a week and a half ago or so when we first kind of touched those levels in the cash. But in the futures, quite a big move on the back of that Trump comment. There was also a few other things, some Fed speakers as well being relatively dovish, did draw some attention. Had that break of that high that was seen earlier in the week, and then we just continue to catapult higher thereafter. So Trump didn't fail to deliver, as is becoming commonly the case, and certainly when there's a quiet day, it's just a lesson to be learned, is that you've got to be always vigilant, especially with the kind of erraticness almost of the deliveries that come from Trump. Never before, I think, has such a influential person, whether politician or central banker, spoke without predefined schedules. This is the thing with Trump. He can essentially, it just comes out of nowhere, so you've always got to be on guard for that type of event, especially in quiet markets when it can act as a bit of a catalyst to get things going. What has this meant then for the global markets? Well, just sharing with you here a bit of an overview of how things are looking globally. You can see the Nikkei as being the biggest outperformer, up around 2.5%. The reason behind that is, if I just show you the yen chart, this is dollar yen, so yen weakness. Again, this is when the Trump comments hit. We had a significant rally higher in dollar yen, more than a point to the upside. So whenever you get that kind of weakness of a fairly big size in the Japanese yen, it does have a direct read across into helping support the export related names in the Nikkei 225. So that was up 2.5%. Elsewhere, in the other markets, you can see in Europe we're broadly positive. The futures did see a small gap higher this morning. The DAX up in the cash about 0.5%. Interestingly, given almost the nervousness in the market at the beginning of the week following those campaign rallies in France, things have drastically quietened down on that regard. And if you look at the CAC 40 this morning, up 0.25%. And if you look at the weekly performance, the French index, despite the kind of sell-off that was seen on Monday and the widening of their spread against the benchmark German Bund, it's actually up around 0.4 on the week. The one, though, that has struggled and continues to do so is the Athens Stock Exchange, which is down on a monthly performance now. We're tracking around a 7.8% loss, or 3%, or just more than that over the week. So Trump comments, they were the main thing from yesterday. Just having a quick look. Trump vows phenomenal tax announcement, but offers no details. President Trump announcing the most ambitious tax reform plan since the Reagan era in the next few weeks. That's what helped catapult the stock prices and the dollar higher on hopes for a cut in corporate tax rates. Again, you remember some of the charts that we've shown you before, 35% tax rate, where in some areas you have to plug on another 4% in regional taxes as well, which is why we've seen back in the Reagan era is when you have maybe a period of cutting corporate tax or having it cut drastically over a shorter period of time in order to have that repatriation of basically funds sitting offshore back into the country to help act as a stimulus. That was all part of the initial kind of thoughts behind the Trump trade and the higher equity move that we saw. So definitely that's, again, it's lacking details, but it seems at this point, given that Trump overall has been more, it seems, concerned about the immigration side rather than the economic side, it was maybe the market took a bit of relief on the fact that now he's starting to talk more on that fiscal elements. The other thing, of course, was the Fed speakers. So this chap, Fed's Bullard, and we also had comments from Fed's Evans. Now Evans said that basically 3 rate hikes this year was not unreasonable, although said that he wasn't sure what the right answer is on the balance sheet debate. So kind of talking it down slightly, and then Bullard came out, downplayed the prospects of a March hike. So his commentary is based on the fact that basically it's unlikely that there'll be any unlikely the fiscal uncertainty will be meaningfully resolved by the March meeting. Therefore, the Fed does not need to move, according to Fed's Bullard, who is a non-voting member. But it's one of the first times you've had someone kind of continuing to play the mantra, if you like, of just one hike, Bullard saying, over the next 2 years. And if you look at the Fed projections, we're anticipating on the Fed forecast 3 this year. He's talking about 1 over the next 2 years. So, a guy that's been kind of leaning dovish, turning ever more dovish in that respect. So maybe that's another factor as well. Continue accommodative period from major central banks. The Fed being one was definitely a reason for equities to rise earlier in the week. Particularly in the wake really of the poor non-farms print that we had at the end of last week. And then, as we said yesterday, there's been a couple of murmurs as well about the ECB potentially following suit with Draghi up until the end of his term, or until 2019, with a similar kind of cautious approach. Some other things to be aware of. Obviously, I just mentioned Greece. Now, it's substantially underperformed the broader European market. It's kind of been a little bit in the background because of the focus, I guess, on the European political scene with the French and Dutch elections looming. But essentially, Greece's creditors may present the government with a framework of measures required for completing the nation's stalled bailout review. This is according to basically sources at Bloomberg, as the prolonged deadlock raises doubts about the country's ability to repay debt due in July. Now, any of those who were trading in the market during the kind of the heights of the European sovereign crisis, when the first bailouts of Greece were taking place, will know that what the market tends to do at this particular juncture, we're only in the middle of February, it already starts to look ahead to what are the big dates of looming debt repayments coming up in the months ahead. Because remember, the market is more priced about expectation of the future rather than the here and now, where they don't actually owe too much. But obviously, in order to have reforms met, frameworks put in place, and tranches paid from various different parties in terms of, let's call it the Troika and so on, it takes a considerable amount of time to get all that in place. One website which was actually particularly useful and will be going forward in the summer when Greece probably gains a bit more traction when those debt repayments are due, is this one from the Wall Street Journal. Basically what it does is it tracks Greece's debt and when it's due to be repaid. You can see here 2017 sticks out like a sore thumb here. They've basically got to repay in total 25 billion euros plus across a multitude of different holders. You've got the IMF, the ECB, the EIB, Treasury bill holders, the European Stability Mechanism, private investors, you name it. Everyone's owed a bit of money from Greece. But the deal is, can they afford to pay it, which is unlikely. Now, this is what you can do here. Essentially, is this is a summary of all years going out from 2017 all the way up to 2055 plus. But you can basically select the given year, i.e. this year, and then this is where you can see July is really the critical point for Greece's economic future, because that's when they have a phenomenal amount of debt repayments coming due, basically. So you basically kind of think of it as you as an individual. You might have credit cards, mortgages, car leasing, all these sorts of things, and just imagine all of that coming home to roost, all in one particular set of just a couple of weeks. Therefore, you're having to need to get your finances in order right now to safeguard yourself from any market nervousness that's already really set in this week in terms of the performance of the Athens Stock Exchange. So looking in July, that's a really critical period. Treasury bill holders are owed 2 billion. You've got private investors owed another 2 billion euros. The IMF are owed 300 million. The big one, though, is the ECB are owed just shy of 4 billion. You start totaling these up, that's a really tricky time for the Greek government to navigate going forward. And obviously, I guess the indirect connotations of this, if they're going to require more financial assistance, is that where does that come from? Who are the biggest contributors? And if Germany needs to give any more money the way of contributions to Greek tranches and bailouts, don't forget you've got a federal German election coming up in September, where Merkel is already, for the first time ever, recently moved to second place in the polls. Now, if you're starting to have to bail out further Greece in July, August, couldn't be any more worse timing for the likes of the Germans politically, which are already struggling on the immigration front. Now they're going to have to deal with the taxpayer front of having to distribute more cash in the way of southern European nations. So maybe something interesting to just bear in mind for the future. Other things that might have added to some of the risk-on general tone this morning is you had some Chinese data overnight. So this was the Chinese balance of trade. It was the largest trade surplus since January of 2016, mainly driven by a surge in exports, while imports also rose further. So you can see here quite a substantial leap from the previous in December, and certainly the highest we've had in some time. Looking on the breakdown, the exports and imports, they just continue to exceed expectations, and going into 2017, you could say it's looking very positive in what had been a real economic headwind only around 12 months ago in January and February of 2016. We're getting a real severe improvement, really, going forward, which, don't forget, is coming in the context of a US economy that's proving to be fairly robust, but you've got good demand elsewhere in East Asia by one of the biggest players in the world in terms of demand side from China, and then you're not hiking rates. If you're to listen to the Fed, you're still taking a cautious approach. So you've got a looser monetary policy, a fairly solid performing US economy, and China's consistently been improving in terms of economic data of late. So some quite interesting developments here, and again makes it very difficult to fight against, I guess, the any reasoning that equities have anywhere other to go than higher at this point. That then leads me into this chap. It's got a great name. His name is Binky Chadha of Deutsche Bank. He's their chief strategist. And Binky has been in focus this morning because he's basically put out his latest recommendation for what he calls for the S&P by year end. Now, everyone's been talking, as we get above 20,000 in the Dow and 2,300 in the S&P, are we getting to overstretched valuations to a point where surely you would think it's got to be unsustainable? But what Binky is suggesting is that this is just the beginning. He believes the rally is reflecting nothing more than the removal of uncertainty around the vote, i.e. US. And looking at equities, he wrote they aren't expensive on an absolute basis and will extend recent gains as earnings in the economy improve. So if you look at this graphic here, you can see that Valuations are not expensive is the argument they're making on an absolute basis. And looking at EPS growth for 2017, obviously the back end of 2015, beginning of 2016 was looking very negative on the corporate front for EPS growth in the S&P, but now we've flicked back into positive for the first time, really going back into late 2014 when we've seen this type of more positive forecast going forward. So his actual end of year target for the S&P is 2,600. Now, don't get me wrong, this is the most punchiest estimate on the upside on the entire Wall Street bank economists who've been surveyed. So he's essentially looking for 13% beyond the Gage's record of where it's traded at the moment. He's looking at an increase in share buybacks. This is also a valid point as well. Extreme short positions in rates will send stocks tumbling and expect sell-offs on any stimulus disappointment to be brief. Post-election Trump rally has not reflected expectations of policy changes or stimulus. In fact, followed the typical trajectory around close presidential elections, pricing out the uncertainty risk premium rather than pricing in policy changes or stimulus. So just some quite interesting insights as we get towards these kind of lofty equity valuations, because obviously the kind of more natural argument would to be looking at the market getting a bit overextended, but this is when you look back at the charts really from where we've been throughout the last 10 years, and again, given what we've just discussed, improvements in two of the world's biggest economies in the US and China in a context of a extremely slow moving rate normalization process from the likes of the Fed and the ECB and other global central banks, it's not that hard to see the other side of the argument. Looking at the calendar for today, there's definitely a couple things you need to be aware of. So just starting off firstly with what's to look out for this morning. You do have the IEA oil market report that's coming out shortly in 10 minutes time. Now that's not really a market mover, but any oil traders, I'd normally just pay some attention to it to see what the latest insight is. It's quite an in-depth report, but very rarely does it really spark any type of immediate reaction. And we're sitting around pivot, finding a bit of support this morning after obviously that big recovery we had yesterday post Tuesday's move lower in that evening on the API print. Otherwise elsewhere you've got the UK industrial and manufacturing production numbers. These are for December. Quick look at that. The IP number last time saw a very strong bounce from the weakness that was seen in the October reading. It came out much higher than expectations, was the biggest increase in fact since April due to a surge in mining and quarrying output. As ever, UK numbers, when it gets to around 10 to 20 past 9, just be mindful of any kind of pre-release positioning that you normally see ahead of some generally more important UK economic data. The other figure obviously is manufacturing production. That has been a little bit less volatile. That was gone from flat in November to previous readings of 0.2. But looking at cable this morning, both major pairs obviously slightly negative amid the dollar, which is a little bit firmer, which is more just, I guess, a continuation of some of the sentiment from Trump and the tax plans from yesterday. We've had a little run lower through that 24.81, which is really the support after that big recovery that we saw back on Tuesday, and that provided support really on the morning of the 8th before we rallied up. So we've had a brief look there before bouncing, but that's probably a level to keep an eye on. Then downside, should we move down, 124.35, the low on Monday, before the bigger move was seen on Tuesday morning. In terms of US economic data, you've got the Michigan Consumer Sentiment reading. That's the preliminary reading for February. This last time, or the last two readings, have been phenomenally strong actually. The last reading being the highest since January of 2004 due to more optimistic outlook for the economy and job growth during the year, ahead as well as more favourable economic prospects over the next 5 years. So in this basis, the consumer sentiment is tracking at multi over a decade year highs where we are at the moment. So I'd be interested to see how this continues to perform as we get more details from Trump in the coming weeks and months. The other thing, of course, is you have today Trump is meeting the Japanese PM Shinzo Abe in Washington. So just to provide you a bit of context here, Trump removing the US from the Trans-Pacific Partnership, his comments about Japan being a currency manipulator, accusations of Japan conducting unfair business practices, could be quite a heated discussion, you would think, given the context and how vocal Trump has been in a negative way towards Japan as well as other major nations. So be expecting a full range of economic ties to be discussed today. Timings wise, what I found so far is that Trump is meeting with Abe. It's going to be our time in London about 5 p.m. So it's not going to come until after actually the close. And then they're holding a press conference, and that's going to be around 6 p.m. our time. Now, even though that might be a time when a lot of you might be already finished up now with the market for the day, that does not mean heading into the event, just from knowing what Trump is like, I would say it wouldn't be unusual for him to fire a couple of tweets out ahead of the meeting, just as a bit of show of force, if you like, a show of hand ahead of sitting down physically with the Japanese PM. So again, be very mindful of any of those tweets if and when they come out. But okay, so that's your kind of morning wrap. So record highs again in the US finish, sparked by some more details on the tax front from Trump yesterday in what otherwise was a very quiet day. You've gapped up a little bit here in European equities this morning. However, they've pulled back and closed that in terms of the Euro stocks. The DAX still seen slightly higher. A couple of positive European earnings to throw in the mix as well. ArcelorMittal up around 4%, Anglo-American up 3.4%, Renault up around 3%. So a couple of those also just helping lift sentiment. Otherwise, the dollar, it's more of a continuation, I guess, of the Trump-inspired move from yesterday. Marginally positive, which has just put a little bit of moderate pressure on both major pairs. And then gold, likewise, as was the case kind of yesterday afternoon, trending lower. It's kind of just held on to that move, so still sitting down around $10 for this morning. Yields as well, not to forget, looking at the US 10-year amid the kind of reinitiation of the Trump trade yesterday, if you like, over the short term. Obviously gold fell and yields spiked higher, so pressured the US 10-year lower as equities rallied all the way into the close. And we're down around 3.5 ticks again this morning. Okay guys, that's your briefing for this morning. So have a good session, and if I don't catch you before then, have a fantastic weekend.